One area that I find fascinating from a market structure point of view is the growth of the buffer ETFs and the options embedded ETFs as a whole. Buffer ETFs right now are about $90 billion in assets under management. And that's more than doubled in the past year. They're projected to be about $350 billion in 4 years, which is again, doubling upon doubling upon doubling. And all of these markets rely on the flex mechanism. And what I find fascinating is flex is not some new flying car product that we're trying to learn. Flex is like the old Bronco that's been sitting in your garage for the past 30 years that just needs a new engine. It's been something we've been doing, we just haven't been doing it at this capacity. That's really where the innovation is going to be, is operational workflows, capital commitments to be able to handle the load of flex trading. Buffer ETFs are definitely going to lead the path and force us to innovate, but once we do, flex is going to start being used by more and more customers, which is really going to grow that market. So that's super interesting.
What has changed since we last spoke?
Last year, we had an interesting discussion based on my experience at being at Eurex for 10 years and in European market structure about the pros and cons and the differences and what made the US so unique in being able to provide and handle liquidity. And I think in the past year, we've just seen this explosion in growth coming from so many different areas, which is exciting. It's coming from product innovation, customer sophistication, the president is tweeting again, geopolitical risk. So there's just no shortage of opportunities to grow in this space.
What are your concerns regarding current market growth?
The growth is coming from all areas. And one thing we really worry about is headline risk. What sort of growth is going to give the customer, especially the retail customer, such a bad experience that we're going to have introduce regulation that's going to kind of stop this momentum. So, we're starting with 24/5 overnight equity and equity options markets, the zero DTEs for single name options, this proliferation of leveraged ETFs, all great momentum in the market, but also need to be done thoughtfully in order to mitigate headline risk. I think the other thing that worries me, especially coming from the European markets, where you have, a European derivatives exchanges, but locally regulated retail markets, which really hurt the growth of retail because there's just not big pools of liquidity like you have in the US, is any fragmentation of regulation. And I think we're starting to experience that with these prediction markets, right? What's going to be left to the states' hands and what's going to be left to the federal government. So it will be very interesting to watch how this plays out, and if we're going to have to rein in some of the products and innovation, because that's going to really scope creep out of federal and into state regulation.
How do prediction markets fit into the U.S. options landscape?
When I was working for Eurex, everyone would be like, well, we're going to wait until there's liquidity. And what I realized is everybody has a different definition of liquidity, right? So everyone's going to have their own customized answer, I think, to this. And that's what we need to kind of get some clarity on from the government about what is, a predictions market. I had this aha moment a couple months ago when we were meeting with a sports index provider, and they are providing indices on the Cubs and the Bears and golf players, individual golf players, but for the most part, it was a well-curated index that's around a single sports venue or team. And what they were trying to do is create a tool for anyone that has financial revenues tied to this team or person. They can hedge their risk. And that's what we're designed to do, right? Commercial hedgers, people who are exposed to financial risk, are able to come into our markets and hedge. And so that's where it's okay, there is a place for these markets, when there's a real tangible financial risk to be hedged.
Do you have concerns about market resiliency and operational robustness?
I don't. And I will say this with a high degree of confidence, having lived through the past year. I think Liberation Day, month, quarter, whatever you want to call what was our last, what it was our last spring, was a fascinating exercise to see our industry's ability to handle an unbelievable increase and unforeseeable amount of load on all of our systems. And we worked very carefully with the exchanges on how to be more efficient while supporting their growth at the same time. And I think it was a real testimony to the industry to think quickly but thoughtfully on how to handle these increases in messaging and traffic on the systems. And I asked SIBO to give me some stats because I did find this very fascinating that last April, they were experiencing 38 billion orders a day on their matching engine with 185 milliseconds of latency, right? And you come a year later and they've doubled their volume in the SPX matching engine, and they've cut their latency down to like 13 milliseconds, on 22 orders in the matching engine. So 22 billion orders in the matching engine. So these stats are just incredible to see that we are still growing at an unbelievable pace, but we're able to do this. We're able to actually think thoughtfully about how to use our infrastructure.
Where do you see the industry and market structure in 5 years?
3 years ago, I was at a conference where the CEO of a major retailer was speaking and talking about how we were going to soon get to 100 million contracts in OCC ADV in the next 5 to 10 years. And here we are 3 years later, and we're almost there. We were just very skeptical at this stat, and now here we are. And I think just the fact that we're also, adding all these unique innovations for, everybody from retail being able to use an app to make yes/no trades in the options market to ETF managers using growing the flex mechanism. There's no shortage of growth in our industry. So the answer is just more.